All right, let's get straight to it. A critical update on Tesla Energy. The number we've all been waiting for is officially out, and frankly, it changes everything for this quarter. So last week, you'll remember, we issued that red alert. We flagged the massive pressure to pull deployments forward before that US tax cliff hit. I said the hard data would be the final word. Well, today, we have that data.
And what does it say? It confirms our thesis exactly as we laid it out. That all-out sprint to beat the tax credit expiration, it looks like it was a resounding success.
And what's really interesting here is how this lines up perfectly with those market rumors about a so-called red shift. You know, that massive overtime push at the Lathrop Megafactory to clear out all of its Q4 inventory. Turns out that rumor was dead on.
Okay, so let's get to the single most important number of the week. And I want to be crystal clear, this isn't speculation, this is not a rumor, this is the official number, straight from Tesla's own investor relations.
And here it is, 13.4 gigawatt hours. That is the official company-compiled consensus for Q4 energy storage deployments. Let me say that again, 13.4. This is now the new floor. It's the absolute baseline expectation that Wall Street is working with.
Now, to put that in perspective, that number represents a really significant 7.2% jump quarter over quarter, and it's roughly 100% year-over-year growth. I mean, think about that. This is the proof we needed. It validates that all that massive new capacity coming online at Lathrop is being completely absorbed by the market. No question about it.
But here's where it gets even more interesting. As strong as 13.4 is, there's good reason to believe that number might actually be conservative. This brings us to what we call the whisper number, right? The unofficial forecast that's been making the rounds among pros. And right now, especially after seeing how successful that red shift was, the whisper on the street is closer to 14 gigawatt hours. So here's the key takeaway. 13.4 is the floor, but there is very real potential for upside when the final numbers are posted.
Okay, next, we need to do some work here and separate the signal from the noise. There was a major headline this week that caused a lot of confusion, but I'm telling you, it's completely irrelevant to our energy thesis.
I'm sure you saw this one, the news that a huge multi-billion-dollar contract with a battery material supplier, LNF, was slashed by 99%. On the surface, yeah, that looks pretty alarming. But this is where you have to be disciplined. It is absolutely vital to understand that Tesla is running two completely separate supply chains. That LNF contract, it was for high nickel cathodes. That's a very specific material for the 4680 battery cells, for the auto division, for things like the Cybertruck. The energy business is 100% LFP insulated from this. Totally separate. Megapack, Powerwall, they use a completely different battery chemistry, LFP. So that LNF news, it has zero, and I mean zero impact on energy production. It is noise. The firewall between the two businesses holds. So, with Q4 now confirmed as a blowout, the next logical step is to de-risk the start of 2026. What happens after that massive pull forward in demand? This is the big question on everyone's mind, right? Is there going to be a demand air pocket? Now that the US tax credit sprint is over, where are the orders going to come from in the first quarter? Well, just this week, we got a really powerful piece of evidence to the contrary. A brand new 1 gigawatt-hour standalone battery project was just confirmed in Eccles, Scotland. And this isn't some small deal. This is a massive project using the new Megablock architecture, and it represents a major expansion for the UK grid. And this is why this matters right now, this one project. It provides a crucial buffer for demand heading into the first half of 2026. It's a loud and clear signal of robust international demand that has nothing to do with US policy deadlines. This is exactly the kind of revenue diversification we've been waiting to see. So let's pull this all together. What does it all mean? Well, the core thesis is completely unchanged. The name of the game right now is volatility management. So let's just recap the key takeaways here. Number 1, the Q4 blowout is now the official consensus. That's confirmed. Number 2, we've filtered out the auto supply chain news. It's noise. And number 3, we have a buffer. International demand is providing a solid floor for Q1 2026. So the bottom line is this. The data we got this week fully confirms our thesis. For investors, the assignment is clear. Manage the near-term, policy-driven volatility because the long-term structural growth story for energy storage, it's not just intact, it is accelerating. And that leaves us with one final thought to chew on. With Lathrop's capacity getting fully absorbed and with international demand clearly picking up steam, is the primary challenge for 2026 even about policy anymore? Or has the story now shifted to one of pure execution?